Let's welcome in a very special guest now. Mahesh Nandurkar of CLSA is now joining us. Mahesh, thank you so much for taking out time for us. Always good to get some perspective from you. Can you just tell us what's happening in the markets at 9,500 level? What sort of earnings recovery are investors building in? What are FIIs telling you about India? Has the mood about India totally changed in the last 6 months?
Okay, so a lot of questions. So what I would say is that at this point in time, the valuations are clearly significantly on a higher side. On an average, the market has traded usually between around 15.5 to 16 times. We are close to 18 times. So we are significantly higher than what the market usually trades at. But having said that, it's basically the equation between the demand and supply for equities. So we have seen over the last 2 to 3 years the domestic flows have improved quite a lot. We expect on an annualized basis the domestic flows to average at about $15 to $16 billion. And what we've seen is that as you rightly mentioned, the sentiments of the foreign investors have also improved. The sentiment that have improved from the foreign investor side is not only about India, by the way. It is about the overall emerging markets in general. So while India has done well, but you must keep in mind that we have outperformed the other emerging markets and the other Asian markets by only a couple of percentage points. So it's not that India is really off the charts as such. So the change in sentiment from the foreign investor side is around the emerging markets in general. And not specifically about India. So, I personally feel that, this favorable demand supply equation for equities is likely to sustain. And therefore, while the high valuations might be making many investors uncomfortable, but I think, this is the reality, as of today, and I don't really see that changing.
Right. Can you also just tell us about, valuations? You mentioned about it. But these valuations would be difficult to sustain if earnings don't come in line or slightly better?
Yeah, absolutely. So earnings growth recovery, will really be key. And, we have seen that last almost 3 financial years now, FY 15, 16 and 17, the corporate earnings growth has actually been quite weak. So notwithstanding the improvement in the overall macro situation, the corporate earnings growth has been very weak. And we have seen the corporate profits, as a share of GDP has fallen substantially. Now, what we are looking forward to in FY 18 and FY 19 is that the earnings recovery should take place. We are expecting the corporate earnings growth to be around 15% this year, as well as maybe a slightly better number next year as well. And if that does not come through, then yes, there will definitely be risk to the downside, given where the valuations today are.
Right. For last 3-4 years, investors have been expecting earnings growth, especially towards the start of April, May, for the next year, which have not come through. So once there was of course, AQR exercise, commodity prices going down, then there was demonetization, which led to that decline. If earnings don't come now, you think investor patience would really be tested?
Yeah, I think so. If the earnings growth does not improve, I think the patience will really be tested, and potentially there could be some GST related uncertainties, and there could be a 1 or 2 quarter in between where there could be some adverse impact on the earnings. But my sense is that the market and the investors will look through any possible near-term negative impact on earnings caused by the GST implementation, because all of us know that GST is good for the economy and for the corporate sector in the long run. So my sense is that any GST related disappointment for a quarter or so might still be looked through, but aside from that, if we get a sense that the economic recovery in general is lagging much behind, then I think we will be in for some negative sort of surprises and the negative sentiments dragging the market down.
Right. You said that GST can be a disruptor in the near term. When you talk to your investors, your clients, or when you are building models for some of the stocks, can you just tell us that you think investors will be rational if there is any disruption as well? Because on the long term, there would be a roadmap which would be laid and how things could go ahead. So at least, that sort of one-off is something which you expect investors to take rationally?
See, the thing is that we have seen the investor behavior over the last couple of years, especially whether it is the domestic investors or the international investors. They have ignored the near-term sort of disturbances. I mean, we saw that happening in case of the demonetization in the fourth quarter of last calendar year, and there have been a few such instances. A couple of years ago, a year ago, when there was this AQR-related disturbances. So the thing is that the market has become mature enough to distinguish between a short-term impact, and a long-term impact. So my sense is that in running up to the GST implementation, even if certain companies or certain distributors, were to decide to destock the inventories, and if that were to impact the numbers for, let's say, a quarter, I think the market, will look through that, as I said, and the investors, are mature enough to know that this is just a short-term phenomenon.
Right. CLSA recently released one big report regarding the housing sector and what is expected over there. Can you just tell us what's the theme on housing? Do you think housing finance, housing-related supply companies, which have been in a structural bull run, will continue to deliver good growth?
Yeah, so it's one of the biggest themes that will unfold over the next several years. What we have highlighted also in the report is that over the last 5 years, the property markets have remained flat. I mean, basically zero volume growth and zero value growth as well. But that is about to change. That's about to change because of two reasons. One is the overall affordability has improved significantly, and our analysis shows that the affordability indicators are going back to the levels of 2003, 2004, in many price segments. Not in the top price segment, but at least the pricing segments of, let's say, 50, 60 lakhs and below. So that's clearly going to be one key driver. And the affordability has improved because, as I said, the last 5 years, the prices have remained flat, but the per capita income has grown by 8 to 10%. Also, we've seen the mortgage rates coming down by almost 250 basis points. So that's one. And the second reason is the government push with the affordable housing scheme, with the home loan subsidy and the tax incentives for property developers and so on. So we believe that the future of the property market is going to be quite optimistic, and things are about to change. So that's the basic theme that we have been talking about, and I think it's a pretty large theme because the property sector as a whole, it's a pretty large part of the economy itself, about 5% of GDP, and has a lot of sort of implications for the job creation as well. So we believe that with this big change in trend expected over the next few years, it's good times for the housing finance companies, the building material companies, including, let's say, cement, or the construction related materials such as pipes and the other materials. And also it will be a positive development for the property developers as well. So a whole host of sectors that will benefit out of this.
Right. When we actually earlier interviewed you, you said that government has no choice but to boost housing. Do you think that boost has already come, or do you think more steps would come to boost the housing demand?
No, I think, in terms of the announcements, a lot of things have been announced. Now, what we'll be looking forward to is the implementation. The government has already allocated a pretty large sum of 30,000 crore for this housing scheme in the FY18 budget. So the government intention is very clear, and now all the sort of eyes will be on the implementation of it. We've already seen that the rural part of the scheme, called as PMAY Rural, has ramped up quite well, and last year we saw 2.5 million houses getting constructed as compared to the annual run rate of around 1 million a few years ago. We would now be looking forward to a similar ramp up of the scheme on the urban side as well, because that has a much higher multiplier impact and much higher value impact. So yes, I mean, what we'll be looking forward to now is the implementation side of it.
Right. So last time around, when in 2004 to 2008, you saw that big real estate boom, which created a lot of jobs, a lot of money supply, was led by price increases of the real estate prices, and then also with a lot of transactions. This time around, you expect prices to go up, that sort of a boom, or you expect volumes to pick up, which was not the case earlier?
Yes, a very valid point, Pankaj. So we clearly believe that this time the property sort of sector boom will be driven more by volumes and less by pricing. Also, the boom would be visible, in my view, more on the affordable segment, or let's say the pricing points of less than 50-60 lakhs, and not the 1 crore kind of houses. Also the big difference between the last time and this time is that the last time the improvement in the activities around the property sector was completely market driven forces and completely privately driven. This time government is intervening and actually giving a boost to the affordable segment much more, and the focus of the government is also on volumes and not so much on the pricing front. So I think that's clearly one big difference. So we should not be expecting any sharp price appreciation going forward, but we believe that the housing subsidies and the others will give a better boost to the volumes, and as I said, mostly in the 50-60 lakh or below kind of pricing points.
Right. Mr. Nandurkar, you're very optimistic about increase in volumes, but where is this optimism coming from? Look at the inventories in the NCR region. Look at inventories in some of the other regions. When inventories are so high, where are the volumes coming from? Yes, the government is giving a push towards affordable housing, but the government is not going to construct these homes. They will be done in association with private developers. Private developers don't have the money to develop it. Their inventory is stuck. They're waiting for people to pay them. RERA is coming. And RERA is going to kick in very soon. So unless they get the act together very soon, they'll be in deep trouble. So where is the volume growth coming from?
Well, a very good question. So the micro markets that you mentioned, such as Noida or Greater Noida or some other parts of India, there are a few micro markets where the inventories are clearly on the higher side, and you would also appreciate that most of the data that we get about the inventories, etc., is also about the houses which are above that 50 or 60 lakh category, which I just mentioned. We are not that bullish on the highly priced housing segment, just to reiterate myself. So I think that's one thing to keep in mind. The second thing is also when we talk about inventories, there's a big difference when we talk about inventories in India and inventories elsewhere in the world. So the most commonly notion about inventories elsewhere in the world is that inventory is something which is ready to occupy, ready to move in, but not occupied as yet. Whereas in India, the definition of inventory is that ready to sell but not sold as yet. So a lot of this inventory is still under construction and also in the very initial stages, so that's one differentiation that we need to keep in mind. The second thing is that you talked about RERA and you talked about other things, but in that what I've sort of always felt is that when the demand comes, the supply follows. So we will not be in a situation where there is more demand, but the supply is not coming through. I don't really envisage that kind of situation. And secondly, there are enough incentives now being provided to the developers as well, those who are those who would be building these affordable housing. So, if you are a developer building a house less than 60 square meters of carpet area, which basically means almost like 1,000 square feet kind of a sellable area apartment, you get income tax benefit under 80IB. So those sort of incentives exist, on the supply side as well.
But, India's real estate market has never been about supply and demand dynamics. Look at the rental yield. It's less than 2%. So, when you have to play this housing boom, you've got to be selective. Everything has moved up now. How would you play it? Because I think the developer side of the story is not looking very healthy. And when you look at housing finance, there is an assumption that affordable housing loans will see an increase. Yes, it could work out. It has always been the American dream to own your house. But the dynamics in India are different. And when rental yields are so low, I mean, it would make sense to anybody that renting is better than buying. So could that quell that sentiment about housing finance as well? How would you play this story going ahead?
So your point on rental yield is very valid, but you must appreciate that that has been the case in India, I guess for the last 50 or even 100 years. So even we saw the boom in 2004 or 2003, the rental yield was, just about 2 to 3%. So, India is that way, quite a unique market. To come back to the original point that you made about how to play this, I think the best way to play this, story is clearly through the housing finance companies. Housing finance companies, whether you buy a 10 lakh, 20 lakh, 50 lakh or a 1 crore kind of a house, housing finance, is something that will be required, any which way. We feel that the, housing loan market, which grew by, close to 14% or so, over the last 4 to 5 years, will easily, grow by 18 to 20% going forward, with the, the kind of changes that we're talking about in the housing market. So that remains our best way to sort of play the story, followed by the building material segment. As I said, some select companies on the cement side and the construction pipes and so on. I agree that the valuations are not really mouth-watering at this point in time, and a lot of companies are trading well above their averages. Companies like 25 times to 35 times on a PE multiple basis. But what I can tell you is that this is at least a segment where there is visibility of growth. Many of these companies will be growing earnings by more than 25% over the next 5 to 7 years. So I think it still makes sense to own this theme.
That's very optimistic. Growth going ahead closer to 18 to 20%. Some can even do 25%, you think. When I don't even know I'll have a job going ahead, do you think I'm going to take a home loan? Look at the job losses across the country. I mean, all that has been spoken about. Do you think there's a lot of over-optimism being built in?
See, the thing is, what we always tend to focus on, is just what's happening around you. So there might be some industries, might be facing pressure. But, if you look at the country as a whole, I think the real growth story of India is really, in towns and, smaller places. We are talking about India's GDP growth in nominal terms, to be around, close to 11 to 12%. And if you knock off the population growth of say around 2% or so, in fact it's less than that, the per capita income growth in India as a whole is 9 to 10%. So don't forget that. So it's easy to get carried away by a newspaper headline, but don't forget the fact that per capita income growth in India is about 9 to 10%. So the newspaper headlines do not necessarily give you the true picture of the entire economy.
Right. Mahesh, let's talk about some other sectors as well. What will be your view on financials? I mean, for the last 5, 6 years, 7 years, private financials have clearly been the best way to play. You mentioned about housing finance. You think that private financials, other NBFCs will grow if actually earnings have to be delivered or your housing targets have to be met?
Yes, I think private sector financial continues to be a very structural long-term growth story, and the logic is very simple. We have private sector banks that have just about 25% market share of the total credit market. The rest is by the government-owned banks where there are some growth constraints. So that clearly remains our favorite long-term structural story, has been for last several years, and I think will be going forward as well. But at the margin, what we are clearly seeing is that the NPL stress is close to peaking out. We feel that the credit costs will be declining going forward as a percentage of assets, and that's actually a good news for the corporate lenders. So we sort of clearly have tilted our sort of focus onto the corporate lenders as well, both on the private side as well as on the government owned side as well, because we feel that the government and the RBI both are clearly very, very focused towards addressing that issue, and we are expecting the resolution of some of the large NPL cases over the next 2 to 3 months itself, and I think that will be a positive news even for some of the PSU banks. So yes, while the private financials and bank continues to remain a very, very attractive story, but I think it's high time we start looking at the corporate lenders as well.
Right. Just in terms of corporate lenders, do you think at least the worst is behind, or prices are factoring in the worst?
Yes, I would think so, that the worst definitely seems to be behind, and as I said, I think the credit cost will actually start declining from FY18 itself. For the PSU banks, as well as for the private corporate lenders as well. So I kind of definitely feel so. The resolution of the entire NPL mess might take some more time. It's not that everything gets resolved in the next 3 months or 6 months or even next 12 months. But I think the direction is what really matters. And given where the valuations are, we are really discounting now more like March 18, and in fact beyond that March 19. And over a 2-year time frame, I definitely see a lot of the NPL related stress getting resolved, and things beginning to improve.
Right. You recently wrote a note about AUMs and what is expected in terms of mutual funds. When we asked you about the India mood check, you also mentioned about the growth in SIPs and the equity flow that is coming in. For a lot of these banks, a lot of these institutions, you think their asset management company could start to give a lot of value going ahead?
Yeah, I think so. The asset management industry as a whole is becoming more and more valuable. In fact, there are some related sort of ancillary businesses as well, like let's say the wealth management, even the insurance is also looking more and more attractive. So I would say that this entire financial services space outside of just the banks which include all these sub segments is looking quite interesting, and can be a very sort of attractive long-term growth story, because if you look at the savings profile of the Indian households, we are still dominantly an economy that saves more in physical assets, but it's good to see that we are seeing that shift slowly happening towards financial assets, so which augurs quite well for all these sub industries.
Why retailers have done very well in gold or retail or any other asset classes? Because they have invested for long term. Do you think that shift has come for equities as well? Right. People will now invest for long terms. If somebody would have invested for long term into Indian markets, the returns would have been much better than gold or any other asset class.
Yes, that is true, but it's a slow change which is happening in the economy. I mean, Indian economy, as a whole, is not as financially literate, as some of the developed world economies are. So it is going to be a slow process, and a lot of intermediaries, like the AMC industry, as you said, will play a key role in educating the investors, and the wider population. And I think we are beginning to see some of that translating into some concrete numbers. I mean, today as we sit here, the systematic investment investment plan is bringing in almost 4,500 crore of inflows every month, and one can very easily argue that a systematic investment plan would be a more sticky, rather than the lump sum investments. So we are clearly seeing some improvement being made on that.
Right. Also, could you just talk to us about consumer durable? You used to track FMCG earlier. You think valuations have now not left any room for upside, or markets are factoring in that GST will lead to the unorganized market, being very low for most of the products that these guys operate in?
Yeah, so consumer staples, sector valuations have been quite high for a reasonably long period of time. So it's not that it's only now that the PE multiples are looking expensive. It looked expensive 2 years, 3 years, 5 years ago as well, but yet the stocks have delivered reasonably good returns. But my sense is that going forward, I think we are coming closer to the revival of the capex cycle. We are not just there as yet, but with variety of things, be it the NPL resolution, be it the expected uptick in the housing market, etc. I think we are closer to the capex cycle revival than we were before, and so to that extent, a lot of investors who did not believe or did not want to play the capex cycle story, ended up buying or holding a lot of their investments in the more stable consumer staple sector. But I think now the market is opening up, and even these other segments are becoming more investable. So my sense is that it is difficult to argue that these high PE multiples in the staple sector can continue for a long period of time. So I would say that it makes sense to be, let's say, geared more towards the capex cycle plays, some of the plays that I mentioned earlier, and even within consumption, I would be more comfortable with consumer durables or consumer discretionary, be it media or be it autos, than staples.
Right. Just to capex cycle, if it actually revives, this would be the best time to own these cyclical plays because they have capacity. So if the sales go up, it directly impacts their EBITDA and they don't have to do any major capex.
Yes, and some of these stocks have also not been doing that well for last several years. So while the PE multiples and the valuations might look a bit stretched for them, for these kind of stocks as well, but these are on very depressed level of earnings, and the earnings growth can come back, pretty quickly. So yes, I mean our sort of focus would be to own more of the names related to the capex cycle, than as I said, say consumer staples, for example.
Right. But again, just coming back to the compounding that was seen in 2004 to 2008, you think infrastructure sector has also become big? So how you have a bifurcation for real estate, even infra, you'll only have select sectors that will pick up, and over a period of time, all the sectors will pick up, unlike what happened earlier where everything was just growing?
Yeah, I think so. Different subsegments will have different, growth trajectories. So, for example, we have started to see some action, on roads, already. We have started to see some action on the urban infrastructure, like the metros, and some of the related things, like we're talking about, some action now beginning to start on the airports as well. So yes, I think the different subsectors within the capex cycle space will begin to grow at like different rates and will have the different trajectories. I think the safer way to still play that story could be corporate lenders, because I think one kind of like doesn't need to bother too much about which sub segment is going to grow at what rate, etc. So if one doesn't want to make that selection and doesn't want to make that choice, I think it's safer to be in corporate lenders, I would say.
Right. So till now we have spoken about sectors where high growth is expected. Let's talk about sectors where low growth is expected. On technology pack, are valuations looking attractive? Are they getting in a zone where investors cannot ignore that sector?
Yes, so valuations are beginning to look attractive, but what we need to keep in mind when we think about the IT sector is that the long-term growth potential still remains suboptimal. So while you could see a valuation related re-rating story in the near term, but if you'll ask me what is the long-term earnings growth, whether it is the next 2 years, 3 year, 5 year, it will be very difficult to justify the IT sector earnings growth to be, let's say, more than 10 to 12%, maybe 15%, at best, but not more than that. So while the valuations are looking attractive, I feel that it's not as strong an earnings growth story or as strong a compounding story, as maybe some of the sort of the other sectors are, some of the other domestically driven sectors are. So I think one can look at the sector, more from the perspective of benefiting from the P multiple re-rating in the near term, but to take a big bullish and a long-term call, on the sector, looks, a little bit, uncertain at this point in time.
Right. Just in terms of IT sector, the biggest theme in IT or biggest compounding story happened because their earnings were predictable. It was quite a stable business. You think it will get very lumpy now with a lot of competition, a lot of variability in currencies? You think it will get very lumpy business and that's why those valuations will never be given to IT sector?
Well, I personally think that it's not so much of the earnings volatility or the earnings lumpiness that has caused the de-rating, but it's just that the sector has grown to a level where it has grown. It's a pretty large part now of the overall market. Also, secondly, we have been seeing some sort of actions and statements from the US president, which doesn't seem to be too supportive of a much higher growth story for the IT sort of sector in India. So by and large, I would say that it's not the lumpiness in the earnings or unpredictability, but it's just the low growth visibility. So as I said, difficult to argue for the sectoral earnings growth to be more than 15%. In fact, more realistically, it will be close to say 11 to 12 or 13%, something like that. So it's that low growth which is weighing down on the sector, and not so much the lack of predictability. I mean, I would say that a lack of predictability is having more of an impact on the healthcare or the pharma sector, where the regulatory uncertainties and some US FDA regulations have caused large earnings volatility for pharma. But IT, I think it's just the low growth that we have to settle into.
All right. Then what do you do with pharma? Because, their earnings have become volatile on reasons outside their hands. If US FDA is beating down on them, the best they can do is improve the GMP practices. Do you think it gets better from here on? Now they've got to pull their socks off, no choice, and they're doing it?
So we continue to maintain an underweight stance, on the pharma sector. We are watching very closely because at some point in time it might become attractive, given where the valuations are, and once these regulatory related uncertainties, get behind, it will be a good sector, to sort of own once again. But for now, we will just remain underweight on that.
Still underweight on pharma. Now, you say you don't like the staples, you would rather look at capex. You think consumer durables are a good bet. Now, the prediction of a normal monsoon is definitely good news. But you said perhaps you should not make too much of what we see in the newspaper headlines about job losses. It could be true to some extent. Do you think there will be a divide now between even the consumption theme on rural versus urban? Because, all said and done, there seems to be at least some uncertainty, if not true job losses in urban India. Do you see a divide coming in there?
Yeah, I think within the consumption side, rural side of the story can look better. Talked about the monsoons already, and we are clearly seeing that the government itself is also focusing much more on the social sector and on the bottom of the pyramid, which obviously makes a lot of sense given that we are looking ahead into the next general elections in 2019, which is about 2 years away, and as one would expect, there will be a greater thrust of the government on the social schemes, and in fact we saw that happening in the FY18 budget already. So I think from that perspective, owning, let's say, the tractor plays would kind of look more attractive within the overall space, as I said, because the rural theme should kind of pan out better.
Does that mean you rather buy the tractors and avoid the pizza players? Is there a divide there in the consumption space? That is my question.
No, sorry, can you repeat your question? I didn't hear you properly.
You said you're optimistic on the tractor players. Does that mean you would avoid the pizza makers?
That's right. That's right.
All right. Thank you so much.
Yeah, see, the thing is...
Yeah, please go ahead.
No, what I was trying to say was that rural story definitely looks much better, and the same thing that I said on the housing side as well. We are more sort of positive on the on the low cost housing rather than the sort of the pure discretionary sort of type of the market. The same thing would apply in the other consumer segments as well.
All right, Mahesh. Thank you so much for being with us on NDTV Profit. So CLSA betting on the growth in Bharat, perhaps over the growth in India. Thank you so much for being with us on NDTV Profit, giving us your views on what is likely to grow strongly from here on and what you're betting on.